our free community financial education forum. Thank you, Business Director Ronald George, for that awesome introduction. Um, I will be sharing and excited to share this part three of our series, The ABCs of Retirement Savings, focusing on traditional retirement options. And so some of these options we all have available, but we are going to cover a lot. And so since it's a lot, our goal is just to make it simple where you'll be able to grasp a hold of the information and then make more confident choices when it comes to your retirement savings or any choices that you have to make concerning money. So, understanding traditional retirement savings. 2 weeks ago, when we started this series, we started off by talking about why should we save and then how much you should save in retirement. And so we do have to consider this because a lot of us will spend most of our years in a retirement situation. You may spend anywhere between 20 to 30 years in retirement. And guess what? Social Security may not be enough to cover all of your expenses. And so by focusing on this topic now and being able to position yourself gives you some kind of control and expectation and allow you to position yourself for the retirement of your future that you want. And saving early allows you to take advantage of compound interest. And so that's something you want definitely to work for you, where your money is working hard and it's not working against you with compounding interest with maybe debt that you have occurred, especially credit card debt. So, when looking at common retirement saving options, a lot of us are used to hearing the words like 401k, but there's also traditional IRAs, pensions, self IRAs, simple IRAs, and that's for small businesses and self employed individuals. And so I hope that this information really helps you when it comes to these options that you will have the opportunity to choose from. So let's get into it. What is a 401k? Because it's buzzing, it's the new buzzword. Should I save in it? What's going on? Well, a 401k is an employer sponsored retirement plan, and contributions are made pre tax. So it may include an employer matching, and we like to say that that's free money. And if your employer, your place of business, offers you a free match, you definitely want to take advantage of that. You are allowed to contribute to this program now, starting in 2025, up to 23,000. And if you are over the age of 50, you're allowed to put an additional 7,500. And when I say contribute, that doesn't mean that, hey, you're going to get a promotion or you're going to get a raise. It means that you are focused on saving the majority of your money. You really want to look at maybe 20 or 30%. And as you increase, as your responsibilities decrease, you want to take advantage of the years that you have and make sure that you're positioning your money in a situation where it can grow and compound for you. So this is being responsible, being able to respond and making good choices and not being a over consumer. So taxes are paid upon withdrawal as you access the money in your 401k. And to look at an overview of it, traditional 401k contributions, like I said before, they're made pre tax, reducing your taxable income. Taxes are paid upon withdrawals. There are an option for Roth 401ks, and these contributions are made after tax, but withdrawals, including earnings, are tax-free in retirement if certain conditions are met. And each savings program has its rules, so you definitely want to get advice and work with someone who can help you understand to make sure that you're complying with those rules. Now, when it comes to an employer match, many employers offer a match, a portion of your contributions, which is essential. And remember, that's free money, and it's definitely a strong incentive to participate. The contribution limits of a 401k are fairly high. For 2025, employees can contribute up to 23,000, and if you are over the age of 50, you can add that additional 7,500. So, how do you fund this account? The contributions are deducted automatically, making the savings consistent and easier. So, you don't take it home, it comes right out of your pay, and it helps you be consistent. In anything that we want to accomplish in life, we have to be consistent, right? So, it is tax deferred growth. That means that investments grow without being taxed annually. And in a traditional 401k, it does allow you more compound growth over time. So you do have protection from creditors. 401k accounts are protected under the federal law from most creditors and lawsuits. So that's really good that your retirement savings is protected in that aspect. Now, some of the cons, the drawbacks to 401ks, you do have limited investment options. Choices are typically restricted to a selection of mutual funds or other options chosen by the plan administrator. So you don't really have a say. Now, sometimes the fees in these plans can be very high to pay for that administrator cost. And early withdrawals, if you access the money before 59 and a half, you will incur a 10% penalty in addition to paying the income tax according to your tax bracket. Now, starting in 2025, there is a required minimum distribution of the age 73. And so traditional 401k holders must begin withdrawing a minimum amount each year. Even if you don't need the money, you must comply with those rules. Now, there are exceptions where you can get loans and hardship withdrawals, but that comes at its own risk. While you can borrow against your 401k, failure to repay on time can result in taxes and other penalties. So hardship withdrawals also come with the strict criteria, and it may jeopardize your long-term savings. So before you look at pulling any money from your 401k, you definitely want to understand that, because a 401k is designed for long-term retirement savings, and this is not a short-term need. So if you're looking for more of an emergency fund savings, then the 401k is not designed or structured for that, although it will accommodate you for hardships. So in a nutshell, what a 401k says that if you have time to save, and if you don't have an untimely death, or if you don't suffer a chronic critical illness or even a critical injury, and if the company you work for doesn't go bankrupt, causing you to lose your retirement savings, and if the market doesn't crash before you're ready to retire, then you will have money for retirement. And so I hope that helps you understand a 401k program better. So moving on to a traditional IRA, this is an individual retirement account, and it's available to anyone with earned income. So, just like the 401k, the contributions are tax deductible and they're subject to income limits. Earnings are they grow tax deferred, and your annual contribution limits is different from the 401k. So, as of 2025, you are able to save 7,000 a year in this program, and your catch up is still 1,000 if you're over the age of 50. Also, taxes are paid on withdrawals. So the pros of a traditional IRA, although contributions may be tax deductible, that means that it reduces your taxable income for the year. It still grows tax deferred. And so investments that grow tax deferred, meaning that you don't pay taxes on the capital gains, the dividends, or interest until you withdraw the money in your retirement. And so, unlike the 401k, IRAs let you invest in individual stocks, bonds, ETFs, mutual funds, CDs, and more, giving you more control rather than having a manager control your investments. It's accessible to everyone with an income, anyone with the earned income in under 70 and a half for the contributions made before 2020. Now there is no age limit, but they can contribute. So no employer is needed. This is great for self-employed people, freelancers, and those without access to an employer-sponsored plan like a 401k. And so some of the drawbacks, the cons would be that the contribution is low, and the income limits and early withdrawal penalties. And just like the 401k, if you withdraw the money before 59 and a half, you will experience that 10% penalty. You still have required minimum distributions. And of course, there is no employer match. So when does a traditional IRA make sense? Well, it makes sense if you're not covered by a retirement plan at work and want to reduce your taxable income. And so, if you want more investment choices, then an IRA is definitely the way for you to go. If you're earlier in your career and you expect to be in a lower tax bracket in retirement. And so tax brackets and taxes is really important when it comes to the environment that we place our money in. And looking at the diagram, we all have 3 buckets that we can place our savings in, and how our savings is taxed determines how much we actually keep. And so we have a tax now, a tax deferred, and a tax-free retirement. Most traditional retirement savings options, they fall in that tax deferred bucket, and that's before tax money, and then it's taxed upon withdrawal. So when you access the money, that's when you pay taxes on it. Now, tax now, everyone is familiar with these accounts. That's your savings accounts or CDs that are offered at the bank. You're actually taxing your dollars twice. So this is after tax money, and then it's taxed with growth. But there are options that have a tax-free retirement. So when you're looking at the best environment to put your retirement savings in, you definitely need to take taxes in consideration. And so that tax-free bucket, that's after tax money with tax-free growth. I like to use an analogy of a farmer who has a seed to help clients understand the difference between a tax deferred and a tax-free retirement, since most retirement savings have that tax deferred. And if they have the option of a tax-free retirement bucket, they definitely want to consider that. And so we know a farmer takes a seed, which is small, and it plants the seed within the ground where they tend to the soil. They make sure the soil has all the nutrients, but they don't expect that seed to produce the same size, right? They expect to have a bountiful harvest. They expect for that seed to cultivate in that ground and just multiply. Well, If you're saving your retirement savings in a tax deferred bucket, you're actually going to be paying taxes on that harvest. So, which one would be better for you in your situation? Would it be better to just pay taxes on the seed, on the small seed, or pay taxes on your bountiful harvest? So, that's something you definitely want to consider because you will hear a lot from traditional people who love to save in traditional accounts that, hey, when you retire, you'll be in a smaller tax bracket. Well, we don't know the future. I know I don't have a crystal ball, so I don't know if taxes will be higher or lower when I get ready to retire or when you get ready to retire. That's a risk within itself. And you have to discover what type of risk you are willing to take with your retirement savings. And with that being said, you have options. It's good that you're getting this education now so that you can save in the appropriate environment. Now we have pensions. And so pensions are kind of like a unicorn right now. They are far and in between, right? So um, there are employer funded retirement plans. They do provide a guaranteed monthly income in retirement, but they're becoming less common in the private sector. So benefits depend on a formula where your years and your service and your salary comes into play. So the pros of a pension is that it provides a guaranteed lifetime income. And that's what you want in retirement. Knowing that, hey, I don't have to go clock in, I'm not having to track down clients. I have this predictable income coming in, whether I choose to wake up at 6 o'clock in the morning or 9 o'clock. It's I can make predictable choices. I know that I can afford to live in the area that I choose. I can afford to take X amount of vacations. And that's what guaranteed lifetime income does for you. Now, there are no investment risks for employees. The employer or the plan provider bears all of the investment risks, not you, and you receive your benefit regardless of market performance. And so a pension, if you have the option to participate in one, it's one of those low risk options. It also encourages you to stay with that industry long term because benefits often increase with tenure, rewarding employees who stay with the company or the agency longer. Now, there are spousal benefits. Many pensions offer a joint and a survivor option. So your spouse can can continue receiving payments after your death. They're not able to contribute. And it's no need to manage the investments or make complex financial decisions. The benefit amount is usually calculated for you. Now, some drawbacks with a pension is they they're not portable. So pensions often don't move with you if you change jobs, or you may lose future benefits or receive a reduced payout if you leave early. And so it does put you in a situation where you are dependent on your employer. And so your benefit depends on the financial health of the employer or the pension fund. And underfunded pensions can result in reduced payments. The control is limited. You do not have a say on how the funds are invested or managed. And it may be more rewarding for someone who is planning to stay with that industry longer. It takes you 5 to 10 years to be fully vested in the plan. That's something that you want to make sure that you understand that vested schedule. It will come with inflation risk. Many pensions don't adjust for inflation, which can erode your purchasing power over time unless you receive a cost of living adjustment. And Most private sector employers no longer offer pensions. They focus instead on 401ks or other defined contribution plans. So, when does a pension make sense? Well, if you work in the public sector, let's say that you are an educator or a firefighter or a government employee, you definitely want to understand the rules of your pension plan and participate. Um, and especially if you're looking at staying long term with that employer, the value is it becomes income stability over an investment risk. So it's pensions. Although they are unicorns, they're still out there. If you have the option of participating in one, definitely understand how it works and how to benefit from it. Another traditional retirement savings options to others is a SEP IRA, which is another way of saying a simple IRA. A SEP IRA for us is self-employed or small business owners, and it has a higher contribution limit. Oh, it's not another, but it's SEP IRA and Simple IRA. I apologize. So Simple IRAs are for small businesses with fewer than 100 employees, and employers are required to contribute. The money does grow tax deferred, and but contributions may be tax deductible, which is a good thing. And so the pros of a SEP is you have a high contribution limit. You can contribute up to 25% of your compensation or 69,000, whichever is less. It's easy to set up. Minimum paperwork, no annual IRS filing requirements for employers, and it's flexible contributions. So, an employers are not required to contribute every year, and contributions may vary based on business cash flow. So, as far as the tax deductible contributions are tax deductible for business and also tax deferred for the employee, and it's available to self-employed individuals. So this is really good for those freelancers, right? And then a simple IRA, a savings incentive match plan for employees. A good thing about that is that the employee and the employers contribute. And so employees can contribute, and employers must either match up to 3% of the compensation or contribute 2% of the compensation for all eligible employees. It's easier and it's cheaper than a 401k and fewer administrative burdens, and it has lower cost than a 401k. The contributions limits are higher than a traditional IRA, so employees can contribute. And when I say contribute, that's savings. So you have restructured, you're not doing a lot of shopping, and you are managing your spending habits, and you are focused on saving. So you can save up to 16,000 as of 2024. And if you're over the age of 50, you can save up to 19,000. So it's great for small businesses. It's designed for companies with who has 100 or fewer employees. But the investing period, all contributions are immediately 100% vested. Now, some of the drawbacks, it has lower contribution limits than a SEP or 401k. And mandatory employer contributions and with the SEP. So employers are required to contribute every year, even in the years where there's low or no profit at all. It has limited flexibility, less flexibility than the SEP IRA in deciding when and how much to contribute. You do have high early withdrawal penalties. This program, actually, you will face a 25% penalty instead of a 10% if you withdraw the funds within the first 2 years of participating. And then there are no Roth options. And so the simple IRAs are generally pre-tax only. Though Roth simple IRAs are becoming more available under recent law change, it just depends on your provider. So overall, retirement planning is essential for financial security, and understanding your options it is very important for you to choose the plan that fits your situation. Definitely consider working with a financial advisor for personalized guidance. You are more than welcome to reach out to us at OYC10K. We will be happy to help you. Remember, start early, even small amounts add up. Maximize an employer match if it's available. Diversify your investments, review and adjust your plan annually. So you definitely want to sit with a professional, someone who works in the financial service industry, sit down, have them schedule a financial needs analysis so you will be clear on your goals, you'll know where you stand, and get excited about your future. So thank you for allowing us to share this information with our community, and we're looking forward to seeing you again. I'm Business Director Erica Ba, and I enjoy giving this information to you. That has been my time. I'm going to turn it back over to you, Business Director Ronald George.
Wow, outstanding job tonight.